All right. Welcome to our August market update with yours truly, Adam Bruner from Flagship Home Loans and Jake Brendel from Goosehead Insurance. So it is summer and it is winding down, getting ready for the fall market. So, Adam, why don't you start and tell us what's new in the mortgage world?
Absolutely. So, wanted to just cover a bunch of like five different things, rather than cover one big topic. And really, over the past month, I don't know if it's because of where interest rates are supposed to go, if it's because everyone's going back to school, but we had a lot of issues come out of the woodwork, right? So I just wanted to circle back on a few things that come up often enough. And I just wanted to remind everybody on the first one is the assumable loan topic. Now, we've touched on this about 2 or 3 months ago. There was articles that came out about assumable loans, and the verbiage has always been there for FHA and VA loans. And I just wanted to reiterate the fact that the fact that the mortgage note is assumable is only half the battle. The other half the battle is whoever currently services that loan has to have means of putting through the assumption, and that's where you run into a lot of trouble. So it's really not the loan itself is half the battle. The other half is, does the servicer have the ability to assume that loan or go through the assumption? And it's been my experience that almost none of the lenders that I am in contact with have an assumable loan vehicle or process. Now, Danielle, you have mentioned once or twice that you have seen them gone through with certain banks, and I would be willing to bet that it's probably smaller local banks that would have means of doing that. They're a little bit more agile, and the way that they service loans is a little bit different. Am I remembering that correctly, Danielle?
Um, I honestly tell people that assumable is not really what you think it is, and don't get excited about the idea. I'm
Yeah.
not sure. I think we were talking about a different topic when I said that. I'm trying to remember what it was, that we were talking about, but I don't think it was assumptions. Yeah, I
Gotcha.
usually tell people one is like you gotta get the seller released from the loan. That's part of it, because a lot of times there's like that murky, they might still be on the hook for it.
Yep.
So.
Yep, exactly. So it's always in the headlines. It sounds great. It's a sexy headline, but it just doesn't ever come out. It just does never work. Never works out with the lenders. The second thing is seller concessions. Obviously, a lot of people that want to get into homes, having the income's half the battle. Do they also have the money to do so? And seller assistance or seller concessions can be a great way to bridge those little gaps. And we can even be creative as a lender where we can show the sellers, hey, we'll increase our price by 5,000 if you're willing to give $5,000 of a seller concession, so that the sellers are netting the same thing. Every month, I say I have at least one deal where there are seller concessions, and that's how we sell them. So as far as the limits, though, get this asked quite often. The limit for a conventional loan is 3% if we're putting less than 10% down. And really, that's the magic number to remember. You can go up to 6 if you're putting more than 10% down, and I think if it's you're putting more than 20% down, you can possibly go up to 9%. But who that's putting 20% down is really looking for seller concession. They're going to have a stronger offer. So the magic number with conventional is 3% seller assistance limited. With FHA, it can be up to 6%. That's the magic number. That will typically cover all of the closing costs that are needed. Now, sellers still need to have the 3.5% down, but that's where we can bring in a grant program or some sort of program to help them with the down payment to have a no cost closing. Then lastly, the VA loan goes up to 4%, and that is enough for a veteran that requires 0% down to have all of their closing costs, escrows, taxes typically met without any out-of-pocket costs. So 3% conventional, 6% FHA, 4% VA.
Also,
Um,
keep in mind though, with the conventional, the one good thing about those higher seller concession amounts on the higher down payments is you might not need them up front at the offer writing, but later if there are repair credits, that's where they come in useful because the roof issues, because Jake, he has the roof issues. I've used it in those cases where I did have a buyer putting down 20%, but we needed like a $17,000 roof credit. and that comes in really handy. So always check with Adam when you're going through that, and you're gonna have to say, hey, what was that percentage again that I can have? Because then you can put that on the sheet. So it is good to have those numbers available.
That was an awesome point, Danielle. I would not have picked up on that. Thank you very much for that.
Go team.
That's a good thought that I'm going to remember. The third thing is mortgage insurance, right? I run into borrowers all the time that are really squeezing the bat tight, trying to put 20% down. And I think a lot of people still have the mentality that mortgage insurance is painful. It used to be a lot worse. It used to be a lot higher, like hundreds of dollars a month. Now, for people with good credit, even if they're just putting 5% down, we see very low mortgage insurance payments. So it's not something to be feared. But what I really wanted to cover is when can it be removed? Because I have a lot of people that are putting minimum down, selling their departing residence, and then recasting the loan or possibly just paying down the balance. So when can mortgage insurance be removed? We'll start with FHA. All FHA loans have mortgage insurance, and if they're putting less than 10% down, that mortgage insurance will continue for the life of the loan. If they put more than 10% down, they'll have mortgage insurance for 10 years. We all know the average life of a mortgage is only 4 to 7 years. So chances are someone that's getting an FHA mortgage, they're probably only getting out of the mortgage insurance when they go to refinance. Now, as far as conventional, there's a few things. Obviously, you need mortgage insurance on a conventional loan if you're putting less than 20% down. But how do we get rid of it? Well, at closing, we have the value of the house. It's the lower of either the purchase price or the appraisal value in the eyes of the lender. So start with that as the value of the house. And we always know at the closing what value they have to get down to or what balance they would have to get down to, which is 20% of that, or excuse me, 80% of that value of the home on the contract or on the appraisal, whichever is lower. And at that point, they can request the mortgage insurance be dropped off when they hit 20% equity or 80% loan to value ratio. But if they happen to forget, it'll drop off automatically when they get to 22% equity or 78% loan to value ratio. Now, when you look at the math, that comes out to about 6 to 8 months. But why pay that mortgage insurance for the extra 6 to 8 months if they can request it come off right at 20% equity? So what I typically do is at closing, they always get that amortization schedule. I take a highlighter and I highlight that magic number for them and tell them put them on the refrigerator. And when you get to that balance, you can request mortgage insurance be eliminated. Now, what about a house that has appreciation in value? With way the values are going up right now, there are some people that might start off with 15% down and might gain that extra 5% with the market going up. Does that mean that 6 months from now or a year they can drop off mortgage insurance because the house increases in value? The answer is no. They can only request that after 24 months. Now, the caveat being if they do improvements to the home and they get an appraisal of the home, they might be able to take that to the lender and have that removed. But if we're talking about natural appreciation of the home, they're going to be in that mortgage insurance for 24 months before they can ask the lender to reevaluate. Next thing I want to talk about creative offers and what I'm seeing right now with agents that are continuing to get tough deals under contract or tough situations under contract. So what I'm talking about are those buyers that are in that range from 200 to 400,000, where everybody's looking to buy a house. It's very competitive. Also, people with limited down payments. How are they getting into homes, or even people that have the need for seller assistance or have FHA loans? Certain realtors are still able to get people under contract pretty consistently. And what I'm seeing is a few things on every offer that they're doing that lead to them getting more offers accepted. And the first one is appraisal gap coverage. Remember, if we are offering more than minimum down, we can add appraisal gap coverage to every single offer and not have our buyers come out of pocket with more money, even if the appraisal comes in light. And again, it's something that's a little bit of an abstract thought there. What we're doing is we're taking part of the down payment, we're applying that to the appraisal gap coverage, and the rest stays the same. So what's really changing for the buyer is their loan to value ratio. Let's just say we have someone that's offering 10% appraisal gap coverage and they're offering 20% down. If that house comes in 10% light, they take that 10% that they or 10% of the 20% that they were offering, they apply that to the appraisal gap coverage, and then the remaining 10%, they're now at 90 loan to value ratio. But here's the key: their loan amount staying the same, their cash to a closing staying the same. The only thing that changes is in that particular case, they might be taking on a little bit of mortgage insurance. And when we're talking about going from 20% down to 10% down, we might only be talking about $35 a month in mortgage insurance for a $400,000 loan. In today's market, who would not take that $35 a month if it meant getting their offer accepted? So again, I say it all the time for agents that maybe don't 100% understand what I'm talking about. Once we put together an offer and you actually see it in motion, it'll click. It's a lot more simple than you think it is, but it's an opportunity that I see missed every day, and I'm constantly reminding agents, hey, throw in that appraisal gap coverage. I'll go over it with your clients. Because if I mention it to buyers and I say, hey, do you know that you can make your offer stronger by offering appraisal gap coverage? And I explain that it doesn't change anything for them and that it empowers them, that hits very different than a real estate agent saying to somebody, do you want to offer appraisal gap coverage? Because when a real estate agent says it to a buyer, what they hear is, do you want to offer more than this house is worth? And everybody's like, well, what am I paying you for? That's terrible advice. So it's sometimes it's a difficult subject to broach real estate agent to buyer, but it's a great opportunity for me to bring it up. And then they'll come to you all excited about it. Like, hey, let's put in this appraisal gap coverage. So we're seeing that work. Appraisal waivers. Remember, Fannie Mae, we can now get appraisal waivers down to 10%. I have two in my pipeline right now. We got to look for it. Most other lenders are not looking for it. They only look for it after it goes into underwriting. And if we can find up front that we have an appraisal waiver, that's going to move our offers to the top of the pile because it takes time out of the process, saves our clients $600 on the appraisal, but really it guarantees those sellers that they're going to get that offer and that no appraiser is going to come in and find things that need to be fixed in the home. And then lastly, you should always be having your loan officer contact the selling agent to advocate for the buyer's credit worthiness and their financials. It takes 10 seconds. I say to the listing agent, hi, it's Adam. That way they know I'm not just somebody at a call center that punches the clock at 5 o'clock. I let them know I'm always available. I let them know that there's no variable aspects to the income if that's the case. And I also let them know that nothing needs to be liquidated. The money is available for the assets that are due at closing. And just that little phone call that takes 30 seconds. When you have a sales listing agent that's putting all their offers together to present them to the buyer, that's moving ours right up the pile because they're going to say, hey, I actually heard from this guy. Even though this other offer is 3 grand more, I don't know about that guy. He's from another state. I don't know what he does, but I did hear from Adam, and this one looks solid. And I have no proof because they never tell us that's the what actually changes it, but I know it moves the needle, and I know listing agents really appreciate it. So make sure we're doing those three things on every offer, and it strengthens the offers, and we're going to get more offers accepted. And then
Question
lastly,
for you, Adam.
what's that?
Question for you.
Yeah.
Maybe somebody coming from outside real estate world might help some of our younger agents. When you're talking about that appraisal gap, right, and covering that percentage, I think about equity, right, and maybe buying and being backwards in equity. Maybe that's not the case, but can you explain how that works? And maybe that could help some folks understand how that
Sure.
works from an equity standpoint.
Sure. In other words, like I would say we would only really be upside down in that equity if you had someone that's offering in other words, their loan amount would be higher than what maybe that they were offering. So that would never really happen. But it would appear that they would have less equity, right? So in that situation that I gave before, feasibly you could have someone going to the table feeling like, well, I'm putting 20% equity in this house, but I'm only actualizing possibly 10%. And that's a real concern, and that's something we want to talk through. But at the end of the day, the market value of that house is what we're paying for it. Now, it might take time for that to catch up, but when you have one house that sells in that area for a certain level, but it only appraised here, well, now all of a sudden the house sold up here, all the other houses in the area can now potentially sell for that. So in today's market, we want to talk to that. We want to speak to that. We don't want to just say, oh, that's not a big deal because it is. But what we're seeing directly is that with these increasing values, it really just takes that one property in the neighborhood to sell at a higher clip, and rising tide raises all ships. But again, we're in a situation where we need to get people in houses. So maybe we do take a little bit of risk. Maybe we might eat 5% of equity, but at the end of the day, we're going to be better off getting that house now than trying to find a house a year from now or go back into the market. It's just kind of a sign of the times. And also, what's the time frame that someone's going to live in that house, right? If they are only going to be in that house for 3 years, we want to be more sensitive to that conversation. But if they're buying a forever home, if they're buying the house where the kids are going to grow up and they're going to go to high school at that house, are we really worried about 5% equity 20 years from now? No, it's more about getting in the right house at the right time. But it's a very good question, Jake, and I certainly don't sweep it under the rug. It's one that we have to talk about.
Thank you. Well done. Well explained.
Yep. And then lastly, removing of sales contingencies. We want to get creative. We see it all the time. If people can carry both mortgages, that's what really determines our flexibility. If they can hold both mortgages at the same time and not have to sell their departing residence before they buy the new one, we can use home equity lines of credit to get the equity out of the house. They can borrow from their 401k. They can borrow from savings and then replenish it after they sell their departing residence. If that doesn't work, we do have bridge loan programs. They do come at a cost. I find that really the value of those programs is that we can write offers without contingency sales, and then we still sell the house or try to sell the house before we buy the new one. So again, that kind of ties into the creative offers. If we can remove the sales contingency in any way possible and get creative with that, it really helps strengthen the offers. So that's all that I really had today. I wanted to cover a couple different things. And for everyone that's watching this in the Foundry, please reach out to me about the appraisal gap coverage. If that's not a tool in your tool belt, it needs to be, and I would love to talk to you more about it.
Awesome. Lots of great information for sure. And we need to be as dynamic and creative as possible. Certain market areas in our footprint are seeing more activity than others, and then certain areas in those market areas are more active than others as well. But if you have a buyer in one of those areas and you're facing 8 offers, every little trick works, or every little trick is worth trying. So definitely reach out to us for help. All right, Jake, you're up next. What do you got?
Cool. Happy back to school week, everybody. Here we are, Insurance Market 101. Yay. I would say, cautiously optimistic, maybe, about the market is probably the best way to put it from an insurance standpoint. So we've been talking about roofs for forever, and we're going to talk about roofs some more today because the way that the market is kind of shifting, I think overall is a good thing. It's a positive thing, but there's some caveats to that. So some catch-22s that I want to make sure I explain so everybody understands where the market is kind of headed, so to speak. So I think today there is more competition as far as insurance companies raising their hand saying, hey, I want to insure your house. So more competition today than there has been really over probably the last 2 years, which is definitely a good thing for the market, right? More competitor or more carriers in the market is best for overall pricing for our clients, right? To secure home insurance. And it also creates a situation where roofs are a little bit more flexible than what they have been in the past. So, over the last year and a half, 2 years, there's been some companies that said, hey, if the roof is older than 15 years, we're not interested, right? Disqualified, not eligible for new business. What's happening now is some of those carriers are coming back to the market, and they're coming back aggressively, right? They're priced well and they want as much new business as they possibly can. So that light switch has flipped, right, for a lot of companies. But it's sporadic, right? So there's some companies that are there, and there's some companies that are still a little bit tipping their toes into the water, so to speak, right? So we're not full bore 100%, but we're getting there. We're pretty darn close. So what this means is if you have a roof that is 15 years or newer, really you have no concern, right? You've never had a concern over the last period. However, if you're in that 15 to 25-year-old roof period, that's where it gets a little bit I think education is important is probably the best way to put it, right? Some companies will offer replacement costs for roofs in those ages, which is what you want, right? And that's what everybody thinks of when they think about insurance. So, for example, windstorm, hailstorm comes, rips off shingles on the roof. The insurance company will replace shed shingles bar none, right? There's no restriction to that. You'll be able to get a new roof minus your deductibles. There are some companies that will say, hey, hold on, wait a second. We will still insure that house, but we're going to either A, have a higher wind hail deductible, right? So you'll start seeing a lot more 1% deductibles, which is 1% of the replacement cost value on the house. So for example, your $300,000 to $400,000 house, if that rebuild for that $400,000 house is at $450,000, for example, to rebuild the house in its same condition, 1% of that 450,000 means you got a pretty darn high deductible, right, to replace the roof. So that's a $4,500 deductible in that scenario before the insurance company will pay anything to insure the house, right? That is where the market is going. There's other situations where they might have that wind hail deductible, and then they might also replace said roof at what's called actual cost value, or you might hear it termed as a roof payment schedule. So really what that means is they're going to replace that same roof, but depreciate the materials for the roof. The older the roof is, the more they depreciate it, and then pay you the difference for said roof. Right. So what does that mean for you? Depending on the age of the roof, you might get 50, 60, if you're lucky, 70% of the total cost that it is to replace that roof, right? And then you will have to pay the difference, right? So lots of confusion on the way that the roof's covered. So I always say this about insurance, and just when I think it can't become more clear that you need someone to navigate the market for you. I think now more than ever, that is so important for buyers, right? Because what happens is, some of these companies that are able to offer those roof payment schedules or higher wind hail deductibles, what do you think that's doing to the overall cost of the policy? Right? There's not as much risk there for the insurance company, so they're throwing out more attractive pricing. So you have a client who's already maybe tight on DTI or putting their pennies together to get a house, and then they're entering this insurance market, and they're just so focused on, well, what is the cheapest possible policy that I can get? Which is where I find a lot of folks every day, really, right? Nobody likes to overpay for insurance. But what I'm getting at is the coverage that you are getting for that policy is so incredibly important when it comes claim time, because, you might be talking about a difference of, I don't know, 50, $60 a month, right? Between some of that coverage for replacement costs versus actual cost value. But when that claim comes, then you're talking about potentially $10,000 difference in payout, depending on, scope of repairs. So, you talk about people that are tight in their budget, that is going to have a much bigger impact than that will on the front end of your policy. So, again, I think now more than ever, so important to have somebody that can educate you on the coverage, different coverages on the policy, different carriers, how they play, deductibles, all this type of stuff, so that you really are truly getting the best value for your dollar when it comes to insuring, for most folks, probably the biggest purchase that they will ever have in their entire life, right? Always here to help with those kind of conversations and help navigate another fun wrench in the insurance market. But I think I can't stress this enough. Overall, I think it's more positive, right? Because as opposed to saying no, hey, we won't insure at all, we're going to give you some options at least, right? You just need to be able to understand the options and kind of push through. So, questions on that?
I have a question, but I think I answered my own question.
Okay.
I think, but we'll get your answer first. So the deductible, is that per claim per year, per policy life? Like how does when does it
Per
reset?
occurrence. Yeah,
Per
per
occurrence. That's what I
occurrence.
thought. I was
Yeah.
so all of a sudden I thought about car insurance and I was like, I think it's per claim because like medical it's
Yeah.
per year. So I was just like, how does that work? So yeah, per occurrence. So basically like that sucks because I mean roofs, I mean roof permission is always buying your own roof. That
Yeah.
costs on that side
Yep.
of the house. Yeah. So
Yep.
Jake, I did have a insurance question for you. It's not on the topic that we're on right now, but it came up this week, and I wrote it down. It's like, I need to ask Jake this. So I had a situation where I have a daughter borrower buying a primary residence. Her credit score is very low, and she doesn't qualify for the loan. Her mom is going on the loan as a non-occupying co-borrower. We're doing it as an FHA loan. Mom owns her own property, um, but has a very good credit score. And they asked me, they said, should I get a quote for the insurance, meaning the daughter with the lower credit, or should the mother get a quote for the insurance with the higher credit score? And honestly, I couldn't wrap my head around that. It's like, honestly, I don't know. I need to ask Jake, is there going to be a difference in their premium depending on who gets the quote?
Those are always fun situations. Are they both listed on the deed to the property?
They will be.
Okay. Um, yeah, that's a tough one because insurance is always how who occupies the property, right? Is kind of the biggest thing. So that's going to be carrier specific, really, where you'll probably need to run that by underwriting to see, hey, are you okay if we insure in mom's name as a primary homeowner, even though she's not going to live there, but daughter is going to live there? And see if the underwriting is okay to write the policy that way. I've seen a lot of those situations go as proper rental dwellings, right? Where we have to write the policy in mom's name and then write it as she's renting that out to somebody else. So in that situation, whether rent is being exchanged or not is really irrelevant in the eyes of the insurance company.
It's more about
It's just
occupancy.
that exactly. It's more about the occupancy. So I would say probably 8 times out of 10, it's going to go that way more so than an underwriting saying, "Hey, we're cool with it." The other
Yeah.
way,
Yeah.
how that impacts the loan, and how you write the loan, I don't know, but that's generally how it's handled on the insurance
Yeah, I
side.
mean, in this case, fortunately, the daughter got a quote that was not terrible, and we just went with that. But it's one of those where I could easily see that going in a different direction with some of the
Yep.
premiums that we're seeing. And I would say that would more be with someone having claims than it would be their credit score, because this particular person had terrible credit score, but a good history on their insurance. So the premium was within what we were expecting anyway. But I could see a situation come up where if the daughter had claims and it would be like $2,000-3,000 for her premium, then maybe having the mom acquire it as rental property insurance would give us a better bottom line.
There's some caveats to that from a coverage standpoint. So I think if it makes sense and you can do it in the daughter's name as a primary homeowner's policy, I would do that all day, every day, right?
Yeah.
So there's it's not huge, but there's some little unique things that can make a difference come claim time. So I'm glad that it worked out that way.
Yeah.
Doing it in mom's name would definitely be plan B for sure.
Gotcha. I mean, at the end of the day, it's on them to figure it out. It's not something I
Yeah.
recommend or steer them towards, but
Yep.
having that little bit of background can definitely help avoid some trouble. So thank you.
You got it. No team go.
we can go. All right. So excellent updates. I just have a smattering of some legal real estate updates. Looks like the Homebuyer Privacy Protection Act, which is trigger leads. For those of you who don't know what trigger leads are, this is if I know I've had a couple people recently. One was my mentee, and another was a client who applied for a loan. So if you apply for a mortgage, all of a sudden you get a bunch of spam texts and calls and messages offering other loans. And a lot of times they blame the lender, thinking that the lender sold their information. So make sure you tell your clients not to blame the lender. It's not the lender's fault. It's actually the credit bureaus who are selling the information. So there is legislation going through to stop this. They're called trigger leads, but to stop the credit bureaus from selling their information. So it did pass the U.S. Senate. It's awaiting the full House vote and final reconciliation, but I guess it does look like it will be going through at some point. So this will prevent those major credit reporting agencies from selling the personal information. So hopefully all of that spamming will stop. But I know my mentee held her phone up and scrolled through all of the calls, and it was insane. And she has a small baby at home, and so it was just like nonstop calls. So it's definitely needed. But you can at least assure your clients, if that's happening to them, that one, it wasn't you, wasn't your recommendation, it wasn't your lender choice or whoever, and that it is hopefully going to stop. So.
And Danielle, I just sent you, and I'm not sure if I had sent it to you before, but I had a preformed email of how to get on the National Opt-out Registry. And
Okay.
it doesn't remedy the situation right away. It takes a couple days. But anybody that gets the calls, I send it out. There's a few layers to it. The biggest thing is the people that are receiving those calls, they probably clicked on a button somewhere along the line when they were either applying for a loan or some sort of credit or insurance. And the little box that they checked said, "Would you like to be notified of lower insurance rates and lower interest rates?" Who wouldn't? They click that button, but really, what it really means is the bureaus sell their telephone number when a mortgage company or insurance company pulls their credit.
Interesting. Yeah. Also, there is a Pennsylvania bill, House Bill 214, if you want to look it up. This bill is proposing an exemption from transfer tax for first-time home buyers. So that's interesting. There are other states that have some similar accommodations. It is bipartisan sponsored, so that could be a good sign that maybe it might make some traction. We'll certainly see, but it is HB 214 if you want to check it out for yourself.
Do you happen to know, does that cover, like, when you get the final closing disclosure, it actually splits up the 1%, 0.5% going to like local taxes and 0.5% going to the state? Would that cover just the 0.5% going to the state, or would that be the full 1%?
I am not sure if it is state and local. It did say transfer tax.
Okay.
So it might be both, because they're trying to eliminate, I guess, the buyer's transfer tax on the purchase. They're trying to, again, help home ownership because it has become like burdenly expensive. So we'll certainly see if it's just a proposal at this point. So we'll certainly see how it shakes out. So we'll see. And then I did see that Florida had a bill get passed that's effective in October. It affects more of the commercial side of real estate. And it is eliminating some taxation there on commercial tenants. So it does look like industrial, office, rental space, retail space is going to be more affordable and business friendly. So Florida has that to look forward to in October. It'll be interesting to see if that gets passed down to the consumer tenants, obviously, or if the landlords keep that profit. But it's HB 7031 for Florida, if anyone wants to look into that more. Next, I saw that the Energy Star rating system might be on the chopping block. So that's something to Google if that might affect you. But apparently it's more than just like appliances and like Lowe's. A lot of businesses do use the Energy Star system for rebates and funding, and also watching their own energy usage and savings across large infrastructures of businesses, because they also have software systems provided by the government that the software then again gauges their usage. Again, on big commercial property management, like larger scale. So the Energy Star system might go away, and the software system that people are using to gauge their usage and efficiencies and again, their budgets. So I heard that might be happening. So something to look into if you have an interest or are utilizing that system, or have clients that are utilizing that system. Obviously, if it's in the early stages, now is when they will obviously have your voices heard if you like that system and want to keep using it. I did look into the Renewing Opportunity in the American Dream of to Housing Act of 25. It's shortened to ROAD, ROAD of 2025. The bill is touted as increasing the supply of affordable housing in the US. I read through it and I didn't see like a ton of impactful things. The biggest thing it seems to be championing is to simplify the construction of manufactured housing by eliminating the requirement of a permanent chassis or foundation. So kind of dialing back manufactured housing guidelines is somehow like the big initiative in this bill. And then more resources in states post disaster recovery. So I didn't find anything super impactful in this bill. Again, they may add to it, they may change it down the road, the road pun, since it's called the Road Act. But so we'll certainly see. But if you hear stuff in the news about that, again, I did read through it and didn't see anything super what I thought would really increase home ownership. Manufactured housing might be beneficial in some states with different climate, maybe than ours. It's not a huge housing element in Pennsylvania. We do have plenty of it, but the guidelines are we need foundations and stuff because of our frost and upheaval and things like that.
I
So,
wonder if some of that's not a response to the trouble they were having in North Carolina with
oh,
putting, because there's a lot of houses that went up, and there was a lot of means to put houses up that had to be stopped because they didn't meet the codes. So I'm almost wondering if that, because it came right on the heels of you saying about the disaster relief and FEMA stuff. I'm wondering if it's not more about that than it is the general housing market.
right. Yeah. So it's interesting. We'll see what that looks like then as well. Also, just updates on the Fannie Fannie Mae and Freddie Mac. There's still talks about kind of what they want to do with them going forward. There's talks about a possible merger of the two entities to just consolidate efficiencies there instead of running two different organizations. And there's also talk about a possible IPO and selling off 5 to 15% of the stock into the private market, obviously keeping a majority control with the government still, just to test the waters and see what the appetite would be in the private market for part ownership of the entity or entities if they keep them separate. So that's something to watch for, especially if you have an interest in owning it. If they do open that up, that would be an opportunity for probably anybody to have a stake in it. And then the last thing is just we just did have at our IVRE Connect webinar in August. That is uploaded now into the IVRE Connect resources. Check that out. There's a lot of really cool things. One thing I like to mention that most people don't know that you can do is you can search for any properties that an IVRE franchise has access to. So if there's a franchise in Florida, you can search their multi-list. So it won't be as all the resources of their multi-list, but you can see agent remarks, who the listing agent is. And so that's really kind of some information we've never had that broad of access to before. So the fact that we can do that through our software system is pretty cool. So if you haven't dove in there and checked it out yet, please get in there and do that. We will have another training for our webinar training in September. But go in, dive into the resources, start learning. But just try that search bar right on the homepage. That's pretty cool. So those are my updates. Anything else, gentlemen?
Have a
No.
great
Good.
rest of the summer.
Yes, enjoy what's left of summer, and we'll see you in September.
Thank you so much. Thank you, Jake. Thank you, Danielle.
Okay, take
Thanks,
care.
y'all.
Bye.
See
See you
you.
guys.